Hello and welcome to this Markets Today special. I'm Udayan Mukherjee. With me is a long-standing veteran of emerging market equity investing, R. Sukumar of Franklin Templeton. Sukumar, great to see you again. And I have to start by asking you about the IT sector in India because there's been so much turbulence and uncertainty following the Infosys results. And at Franklin Templeton, you've owned many of these technology large caps for a long time, many years and decades. Is there sufficient reason to be worried for long-term investors into Indian IT?
Good to be in the show, Dayan. So the IT sector obviously has grown. It used to be a small sector in relation to the IT spending, and now the Indian IT companies have captured a more substantial portion of the global IT spending. So when I think they used to, have a small share of the whole pie, they could grow even when the pie was shrinking by gaining market share. Now, I think that is probably a bit more difficult nowadays. And that's why I think they are more exposed to the global cyclical issues. So they will be more cyclical, but I think the longer term growth prospects are still reasonable, though the growth rate expectations have to be lower compared to what we have seen in the past.
How are you calibrating all this as an investor? I mean, do you now make adjustments for what kind of valuations would be fair for a lower growth paradigm for IT companies? Does that call for pruning down some of your holdings or investments into Indian IT?
So we basically discount cash flows, and when we discount cash flows, we are looking at lower growth rates as time progresses, and so then we compute what is the intrinsic value for each of the companies. We have reasonable upsides to some of the names, but not all the names. So we need to be selective, and even where there is an upside, I think the upside is not huge. I think it's probably reasonable, but not very large.
Is this an industry-specific issue, Sukumar, you would say, or a company-specific issue? I mean, Infosys is a large company, but should you brush all companies with the same stroke now, or do you make adjustments for individual companies that some growth rates would be not equal to others? You cannot paint it all together.
The risk profile of companies might vary depending on how diversified they are, what type of clientele they are exposed to, etc. Generally, I think Infosys is a company which has scored well on many of these metrics, but unfortunately, this quarter they've been exposed to some difficult situation that the clients are facing. So I would think that it's more of an exception than the rule for companies like Infosys. That is the risk. These companies run by penetrating more and more clients, and which means that at some point they will have clients who will face difficulties and have to prune their budget.
You made an interesting point just now. You said that because they've become so large, it's very difficult for them to keep growing at the pace at which they were growing earlier. Does that mean that mid-cap IT companies in India stand a better chance of higher growth for the years to come, or not necessarily?
They could, in specific instances where I think they are exposed to clients for growing very fast and less exposed to clients who are facing difficulties, etc. But they come with a different risk profile as well. Companies like TCS or Infosys, they have a very large client base, and they are in multiple verticals and horizontals. So they can continue to grow for longer, whereas companies operating in specific verticals or horizontals, when I think growth becomes a challenge in that particular vertical or horizontal, they might face challenges. So different challenges. But in general, I think the risk profile of companies like TCS Infosys is lower because of the diversity of the client base and the diversity of their offerings.
Should one translate what's going on in the IT sector to other global facing sectors, Sukumar? Because this is clearly a global problem. And I think most investors into Indian stocks are wondering whether this extends to pharmaceuticals, chemicals, all the large global facing sectors. Should we be prepared for earnings slowdown in many of these globally facing sectors now?
Where our penetration is very high, that would be a challenge. Where the penetration is low, it would not be a challenge. For example, you might be seeing the headlines that for the calendar year ending December 2019, and Apple had a certain amount of export from India, and then for the quarter ending March, it's substantially more. It's not that iPhone volumes are growing substantially. It's just that India has a small share of the Apple production base, and that's an opportunity to grow market share. But in categories where the penetration is very high, we would be exposed to global, cyclical issues.
Any examples from the large export sectors in India which are listed in the stock market?
IT services for one, where we have very high levels of penetration. Generic drugs, we have been facing, companies have been facing that challenge for some time. And that's why, the better quality companies are trying to go into specialty products where, we don't have too much of share, and we have some opportunities to increase the presence there. Electronics manufacturing, we have a very small share, and that's an opportunity to increase the share. And there are a lot of emerging sectors where India is trying to penetrate the global markets, where those challenges are not going to be there in the short to medium term.
You spoke about manufacturing just now, where you gave the iPhone example too. Do you find as an investor enough prospects in the listed universe where you can play this global manufacturing theme that a lot of people are getting excited in India about?
Right now, it's more indirect than direct because, for example, the assembly of iPhone is primarily the Taiwanese, the manufacturers, and the Indian companies which are going to be benefit are going to be indirect beneficiary. It might be in financial services, it might be in consumer products, it might be in infrastructure, and so on. But over a period of time, I do believe that we are going to see some listed companies which are supplying components or possibly assembling some of those products. But that's not for today. It's going to be in a few years from now.
Now, after the Infosys results, a lot of companies, brokerages have scaled down earnings prospects by between 5 and 7% for the year. And we know that IT services is a significant contributor to the overall earnings of the index in India. Is there reason to moderate earnings expectations overall for the Nifty or the Sensex for the fiscal year 24 now in the light of what's going on globally?
Yes, IT services growth is likely to be challenged. But there are some other sectors which are doing reasonably well. And also, if you look at fiscal 23, sectors like metals, cement, etc., there's been a big contraction in earnings compared to FY22. If they can grow from the low base of FY23, they could provide some upside as well. All in all, I think FY24, we should still probably expect mid-teens earnings growth, which is not which is still very respectable. And probably that's a longer term potential as well.
Right. How much of this is in the price, Sukumar? Because the constant complaint that we hear from investors is that while 13, 14, 15% earnings growth is respectable in India, but valuations capture most of it, and therefore there is better value to be had in other Asian markets. Do you concur with that thought?
No, not really. So while I think from a PE point of view, we are at a longer term average, but I think the resilience and sustainability has been improving for India. I think there are a lot of more sectors which have become dynamic. The economy itself has become more resilient. We don't have a huge current account deficit like we used to have. We are in a position to generate foreign foreign exchange earnings, which is required for fueling our growth through investments, and that would require imports as well. The fiscal situation is much better. So I think the risk profile of the economy has declined substantially, and that should also get that should reflect in reduced risk premium as well. So overall, I still think the market is very attractive. Some of the markets in Asia are very cheap, but they have huge challenges, and I think lower P multiple is also a reflection of some of the challenges that they are facing.
So you're not in the camp which believes that India continues to underperform other Asian equity markets in the current year. It has underperformed for the last few months, but you don't see that continuing.
I would say unlikely. The current consensus is, be underweight India. That's what many other strategists have been saying for some time. And so that trade, I think, is already over. And I think going forward, I think India has an opportunity to be more resilient. First of all, I think the net inflows from the domestic investor base will continue. And on the margin, I think there's a chance that some other global investors might like the longer term structural story and allocate more.
Mm. We've started seeing something like that happening over the last few weeks. I mean, after many months, we've seen FII flows turn positive. Do you think it's the beginning of the turning of the tide, or is it just tactical money which is allocating to India after a spell of underperformance?
It's a combination of both. There are some people who are rotating between markets, but there's a huge opportunity to gain some allocation from global funds and longer term investors like pension funds, etc. Many of them haven't really allocated to India on a standalone basis. But if the Indian story is going to be different, I think there's an opportunity to see such allocations. We have seen some such clients looking at India. If you're going to see more of them, then I think then the flow picture can change more materially.
India, of course, is part of the emerging markets basket. At what point do you see money actually beginning to look at emerging market equities more seriously? But do you think that time is only when or if the US goes into recession, where people find it difficult to expect returns in those developed markets and then turn to emerging markets? Do you think that kind of a tipping point might happen sometime this year?
It's a possibility. Definitely, I think we are going to see a slowdown in US, and the earnings growth outlook for many of the companies is not that great. If under those circumstances, our companies, Indian companies, demonstrate that their fundamentals are intact, they can continue to grow. The Indian economy demonstrates, 5% plus growth, which is highly likely to happen. Then I think, there can be a lot of more investors who look at India differently.
Is it tied to the US recession outcome, or more whether the Fed eases off or not? I mean, people have been talking about the Fed pivot for a long time, when the Fed starts to pauses and then starts to reduce interest rates once again. Do you see that being a trigger for the money flows into emerging markets, or is it a recession and growth outcome which dims in the West and propels people to look at emerging markets in Asia?
I think the most important factor is I think the understanding of the India story. Whether it's how differentiated it is, and even today I noticed that not so many investors are so well educated on that story. Part of the reason is the people in India are more negative than some of us who are not based in India. And I think there has to be more positive voices coming from India saying, things are great here, and which I haven't seen really. But looking at India from here, there are so many economies where I think 5% growth is a big challenge, especially on a sustained basis. And we have a variety of companies, and many of these companies are so resilient and have demonstrated earnings growth over a long period of time. And I think that story is not well explained. And when more people hear that story and see the differentiation, I think the interest will increase. As far as interest rates are concerned, um, my view is that we are not going to see the interest rates go to the levels we have seen before. I think the world has changed, and I think multiple supply chains are being created. So the investment demand is going to be much higher. The capacity utilizations are going to be lower. So price pressures would continue, and it's very difficult for inflation to settle down to the levels that we have seen, where we enjoyed the benefit of very robust global trading system where people were willing to trade, and now I think countries want to create supply chains which they feel comfortable with under the geopolitical situation, and that would mean that the cost structures are going to be higher, and that will feed through into consumer prices over a period of time. It will also lead to higher employment in some of the developed countries where I think the slack in the labor force is very limited. And that's also a source of inflationary pressure.
We spoke about the traditional services companies, Sukumar, earlier. What about the new age digital companies? I mean, the Paytms and Zomatos and Nykas of the world. In your book, have valuations corrected sufficiently for you to look at them as an investor?
Valuation is not the primary challenge with those companies. I think demonstration of profitability is going to be key. I guess the issues might be different for each of those companies, but I think people have to understand the business models and feel comfortable that they are going to be profitable. And I think the companies are pivoting towards profitability, but it's not very clear to variety of investors that they will be on a sustainable basis.
So, Kumar, great to catch up after many years, and pleasure talking to you as always. Thank you very much for your time today.
Thank you. Good to speak to you.
If you like the video, do like, comment, share, and subscribe.